Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London coffee markets.
New York coffee. Until the last 2 weeks, we had seen a continuation of the resultant move lower from the February to June diamond pattern. The primary target for a move down from this diamond pattern was down in the 156.35 zone, which prices achieved in mid-August. This left the secondary hard-to-reach target X1 down in the 141.80 zone, just below a small bank of congestion between 142.45 to 143.35, based around the September 2017 high at 143.35 and the 2019 high at 142.95. Given the very recent action of the market reacting higher, I've decided to retire this harder-to-reach secondary target after this commentary. Okay, so though we have had overall been moving lower, there have been a pair of interesting bullish patterns in September and now October. These consist of the weekly key reversals up in mid-September, as well as the weekly key reversal up 2 weeks ago. The earlier September one caused a rally that eventually ran out of steam, a little short of the declining medium moving average, currently 159.55. The more recent weekly key reversal up punched up, as we also saw in September, through the short medium moving average, currently 153.40. But this time, last week saw the market punch up and clear the declining medium moving average. The first time that's happened since June. We now have overhead 2 significant resistances to look at. That's the flatlining long moving average, currently at 169.30, and above that, the significant congestion from the 50% Fibonacci line of the May 2019 to February 2022 move at 174 even, with its nearby partner, the August 2021 low at 174.5. These are not all, as we have further significant overhead resistances further higher, which I will detail as and when we get closer. There are 2 further features that I would like to discuss and highlight. The first is the possibility of a monthly key reversal in October. If on Tuesday, the 31st of October, we either see a close over 154.5 or under 147.20, then we'd be on. Secondly, I would like to consider the action since mid-September as a possible ascending scallop pattern. It's early on, but this pattern does have merit here, and I would like to explore this more fully once we see such a pattern fully evolve. London coffee. The descending wedge pattern, currently 22.53 to 23.16, that is highlighted on my daily chart in dark blue, had been the dominant pattern here since June, despite being broken in September. How this pattern has run its course, and so we will relegate it for next time, as there are 2 possible new patterns emerging that seem to be highly influential, and I'm wondering if they will act together or fight it out amongst themselves. The first pattern is one I had previously mentioned last week, and it is how the descending wedge pattern could be morphing into another pattern, another bearish pattern, a possible bear channel, currently 21.90 to 25.43, which I've roughly outlined on my daily chart, but as yet have not yet highlighted, as it is still early on for this pattern and for such an idea. Just bear in mind for this idea that there is a congestion band between 21.53 to 21.77 for a lot of highs from 2017 mixed in there as supports. Secondly, and this idea has only really formulated itself over the last 2 weeks, is look at the action throughout October as a possible ascending scallop wedge pattern. It is early on in this idea, but it does have merit. What we need now to look for is whether the rally, which has punched up through the congestion between 24.05 and 24.12, that contained the declining short medium moving average, currently 24.12, as well as on Friday punching up through the declining medium moving average, currently 24.98, though the congestion at 25.18 capped the rise and prices closed below the medium moving average. It's whether this rally is really the start of the ascending scallop pattern, or whether the upper bear channel, currently at 25.43, will be enough to cap the rally. As I said earlier, it is a little too early to tell just yet.